If you're a first-time homebuyer, getting to know the process of mortgages and mortgage payments is essential. How do payments work, and how often do you need to pay? Well, mortgage payments work in various ways because each type of mortgage has a different length, payment schedule, and interest rate. For that reason, it's important you choose the right mortgage for you. Step 1. Choose your mortgage amortization period. Once you buy a home, it's time to start repaying the mortgage, plus interest and mortgage fees. Typically, the repayment period ranges anywhere from 5 to 25 years, with the most popular mortgage term being 25 years. You can choose the length of time you have to pay off your mortgage. We call that amortization. The longer the amortization, the smaller your monthly payments, but the higher your total interest paid. The shorter your amortization, the bigger your monthly payments, but the lower your total interest paid. Confused yet? Let's look at a sample amortization schedule where you borrow $400,000 at 7% interest on a fixed term with monthly payments. If your amortization period is 15 years, you'll pay an extra $247,000 above your mortgage on interest. If your amortization period is 25 years, that increases to $448,000 of total interest on top of your mortgage. Of course, the decision will ultimately be made based on how much of a monthly payment you can afford, but this chart should provide you with food for thought. Step 2 in the process of getting to know your mortgage payment is choosing your mortgage rate terms. Once you have your amortization period, you also need a mortgage rate term. Although confusing, there is definitely a difference between the two. As we mentioned previously, your amortization period is the total length of your mortgage, whereas your mortgage term is the length of a contract, which calls for renewal anywhere from 6 months to 10 years. For example, you could have a 25-year mortgage with a 5-year term, which happens to be the most popular option. When it comes to the mortgage term, the options for interest rates are fixed or variable rates. A fixed-rate mortgage does not change for the period of borrowing, whereas variable rates adjust over time in response to market changes. If you're not sure what option is best for you, consider your personal financial needs. Fixed-rate mortgages are popular because once you've gotten your rate, it stays the same for the chosen term length. The only reason it's not always the best choice is that you may pay a much higher rate than where the market currently sits. For variable rate mortgages, although the uncertainty with price increase can be enough to stop any homeowner from taking the risk, they're historically less expensive throughout the duration of a mortgage. So what does that mean? Well, if interest rates are low, it might be the right time to lock in a fixed rate. But if you anticipate the market might fall shortly, a variable rate might be your best option. Now that you have your mortgage terms and your amortization period, it's time for step 3, choosing your payment schedule. Your first mortgage payment is usually due at the start of the first full month after closing. So, because mortgage interest is paid after it's accumulated, your August 1st payment would include interest for the portion of the month you owned the property in July. Each month, the buyer is responsible for making mortgage payments. Part of that payment will go towards the initial borrowed amount, otherwise known as the principal amount, and the rest of the payment will go towards interest, just like we talked about when we went over the amortization period. You can make your mortgage payments monthly, bi-weekly, accelerated bi-weekly, weekly, and accelerated weekly. Most homeowners choose to pay their mortgage in line with their payment schedule at work. For instance, if you receive bi-weekly paychecks, you will pay your mortgage bi-weekly. Depending what payment schedule you choose, there are differences in your overall payment total. For example, accelerated mortgage payments can help with the equivalent of 1 additional monthly mortgage payment every single year. So, although you'll be paying slightly more each month for your mortgage payments, you can save thousands of dollars on interest long term. Whatever you choose, just remember that you are free to change your mortgage terms as soon as the time comes. Whatever you do, just make sure that you do your research and speak with a mortgage professional. Mortgage payments, although costly, are simply there to provide you with the opportunity to own a home in a more affordable way.